Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing how to make money in crypto using Fibonacci retracements, part 2 of 2. What do Fibonacci levels represent? The Fibonacci levels used within crypto trading are 23.6%, 38.2%, 50%, 61.8%, and 100%. They represent psychological barriers that repeatedly show up within the crypto markets. Another interesting aspect of Fibonacci levels is, as with many indicators, the fact that they become more accurate with more people using them respectively. This falls under the self-fulfilling prophecy paradigm. How to use Fibonacci retracements? The Fibonacci retracement levels consist of horizontal lines that highlight areas of expected support and resistance. To create the Fib levels, you will need to draw a line between the lowest and highest point of a particular trading cycle. It's up to the trader to choose whether they will use wicks or candles. Fibonacci retracements are a very popular tool amongst technical traders, as it allows them to identify levels where they can place their entries or exit points. More times than not, the market tends to struggle near the Fib levels. Whether it is the nature of the self-fulfilling prophecy, these levels do seem to work, and there are many traders that utilize Fib levels to profit in the volatile crypto market. One thing to note is that you will never know how far the price will retrace exactly. This means that you cannot predict which Fib level the price will respect. That's why it's better to carefully watch the markets and wait for a level reaction before entering a position. Can Fibonacci retracements be used with other indicators and tools? Yes, they can. In fact, it's highly recommended to use Fib retracements with some other indicator. If other tools and indicators overlap with the results of Fibonacci retracement levels, the expected result is that much more realistic. An example of using Fibonacci retracements. Fibonacci retracement levels are very efficient when it comes to predicting a bounce off a big red candle upon the completion of a quick rally. These fairly quick trades can generate some good profit if timed properly. In conclusion, many traders use the Fibonacci retracements to decide where to set their buy orders. However, most of these traders use indicators such as volume and some momentum indicators alongside Fibonacci retracements to increase the overall security of their decision. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.